So now I'd like to introduce the team. We have Kim Zook, Chris McAvoy, and Wyatt Lee, but first I will pass it over to Kim.
Thank you so much, Leah, and good morning and good afternoon, everyone. My name is Kim Zook, and I lead the USI retirement business for T. Rowe Price, and I'm thrilled to be here with you all today to kick off what we believe is one of the most innovative and exciting opportunities for our firms to partner together on. And so in terms of our longstanding relationship with RPAG, I did, before we get into the launch, want to thank you all of the advisors on the call for your business and your continued trust in T. Rowe Price. It's an honor to partner with you to serve our combined and mutual retirement plan sponsor and participant clients. Today, I am joined by Wyatt Lee, who is our portfolio manager on the target date funds, and also on the line, but not on video, are several members of the T. Rowe Price National Accounts team, led by Carrie McKenzie, Jay Kim, Chris Arkfeld, and Christine Carolon from our record keeping side. And together, we think a lot about waking up every day about how can we serve our clients in meaningful ways. We have a long, strong track record with RPAG. Our relationship is 36 billion strong. And that really is in large part to the recent single sleeve large cap growth opportunity. And when our firms came together to discuss this new opportunity, the first fully active target date series with T. Rowe for RPAG members, we have been beyond excited to roll this out. And so what we'd like to do today is introduce you to Wyatt, who is the lead portfolio manager. He is going to walk you through the strategy. He's been leading that effort, and the team is responsible for the significant growth of our target date franchise. And also at the end of Wyatt's presentation, we have on the line Chris McAvoy, who is a member of our DCIO field sales team. He's going to moderate a Q&A. And we hope that you will, as Leah mentioned, enter your questions into the Q&A box. So together we can make our relationship with all of you stronger than ever. So with that, I'm going to hand it over to Wyatt to take us away and talk about this exciting opportunity.
Thanks, Kim. It is really great to be here today. I'd like to share my excitement as well about our partnership around the newly created Wilmington Trust T. Rowe Price Retirement Date Trust. I think it's a great opportunity for us to partner and have success together. And so, as Kim mentioned, I'll spend some of the time with a brief update on the strategy, but I really do hope to leave a reasonable amount of time for questions at the end, because I think that's probably the most valuable use of all of our time today. So if we could move ahead to the first main slide, just to highlight here what we show on the page are what we think about as the three key differentiators and the three main ways that we can add value from a portfolio design and implementation perspective across our retirement trust. First and foremost is the glide path that we have in market. In the product that we've designed here, we take a very differentiated approach to our design. We're well known for the growth orientation of our glide path, both early and into retirement, but that's purposely designed in a way such that the portfolio can address the needs of participants to help offset the negative impacts of their longevity risk and their needs for income over what can be a very long time horizon in retirement. Secondly, we believe in the opportunity of active management. As a firm, T. Rowe Price has always been known for our deep research resources and our long-term viewpoint on fundamental active management. From my perspective, the ability to generate alpha over the long term ultimately accrues directly to participants and can help them achieve their retirement goals. And I really do believe that this is ultimately going to be more important on a going forward basis. When I pulled up my performance page last night, if you look over the last 10 years, the S&P 500 has delivered about 13% annualized over the last 10 years. In that type of environment, it can be very easy to overlook the impact of additional basis points in outperformance because of the low fee. But if you believe, like I do, that we are more than likely in a lower return environment, an extra 50 to 100 basis points that we can earn over the long term on a net of fees basis can be really critical to investors trying to save for retirement. In addition, and oftentimes overlooked with regards to active management, is a viewpoint on portfolio construction. There are a number of areas of the market that we invest in, and I can point them out later, that we believe are just not appropriate for active management, or excuse me, they're not appropriate for passive management. And therefore, by having exposure to active management, it gives us a much more diversified portfolio that can provide benefits over the long term. And then lastly, while you think about the glide path and active management as being very long-term, we also know it's important to navigate the short term. And so we have a process that has been in place for more than 30 years of dynamically adjusting the portfolio, taking tactical positions both offensively and defensively that can help us manage risks as well as enhance returns in the portfolio. And together, these three things, right, when you put them all together, our approach, our process, and our team has led us to the gold rating that you can see on the next slide. We earned this gold rating from Morningstar last year, and it was reaffirmed earlier this year. And in addition, we were the first fully active manager to receive the highest rating on the three pillars that Morningstar uses to evaluate target date funds in terms of the people, the process, and the parent. And so I think it's always great to have key external validation of our approach, something that we can point to of an unbiased third party that is giving us such a strong endorsement. And then more so on the right-hand side of the page, the delivery of that. Morningstar star rating is driven on risk-adjusted performance, and all of our trust vintages have earned a 5-star rating, demonstrating that over that long-term period, we have been able to generate strong risk-adjusted returns versus our entire peer group. This process and the team we have in place has generated long-term strong performance for us. As you see on the next slide, we look to demonstrate the consistency of our performance. Strong performance over rolling 5 and 10-year periods. You can see that in 96% of the rolling 5-year periods since the inception of our trusts, or actually going back to our mutual funds, since the inception of the strategy, have been top quartile. And over rolling 10-year periods, we've been in the first percentile over 97% of those periods. I think this consistency is unparalleled in the industry, and it really speaks to our goals of working to deliver over the long term. And ultimately, this delivery over the long term accrues to participants. On the next slide, we can show you the impact that our approach has. What we've done on this slide is we've compared an investment in our 2020 portfolio versus the S&P Target Date 2020 index. And for those of you who aren't familiar with the S&P index, it's designed to represent effectively the industry average target date, and then use those allocations or represent those allocations with passive exposures. And so if you were going back to when we incepted the strategy in September 2002 and made an investment since that time, the S&P Target Date strategy would have grown assets to about $388,000. However, if you had invested in our product, you would have earned actually $491,000. Right? About 102,000 of that is being driven by our glide path and our diversification, and another 25,000 of that is being driven by our active management and our tactical allocation. What this demonstrates is our long-term strategy in the retirement space has really helped investors be well prepared for retirement. And we continue to believe that this strategy is going to keep participants to be best placed to have successful retirement outcomes in the future. Now, digging into a little more of the details, when I think about our strategy, on the next slide, it really starts with the team. You can see at the top here, 3 members of the portfolio management team. As Kim mentioned, I lead the group, but I partner with Kim V. Dominicus and Andrew Jacobs Van Merlin. We have worked together in various ways for more than a decade, and I think this is critical. Our working together really lends to us a strong collaborative culture, as well as consistency of implementation over time. We're supported by a team of specialists and analysts, and maybe even more important at the bottom of the page, dedicated resources to analysis and implementation that ensure smooth operation and implementation of our strategies. And then also what I think of as the deepest research team in the industry that make us well positioned to be able to keep our portfolios at the cutting edge to continue to deliver in the future. Moving on, we can take a look at our glide path. As I mentioned, we do have a relatively growth-oriented glide path. And this is really because it is focused on those long-term inflation, those long-term longevity risks. However, as we build it, we think about taking the right risks at the right time. Early on the left-hand side of the slide, you can see our early emphasis on growth assets, starting with an allocation of 98% equities. Here we recognize participants have a long time horizon, small balances, very little downside. So it's really important, it's critical to take advantage of the opportunity for growth early. As we move on and get closer to retirement, we understand market risk becomes more important. And so we have more of a balanced profile around retirement, focusing on still having enough growth orientation to meet retirement needs, while also recognizing the downside from the growth orientation. And then we continue to de-risk, right? Making sure that we have the right allocation throughout retirement, not reaching our most conservative allocation until 30 years past the targeted retirement date. Beyond that, once we develop the glide path, then we have to diversify. And you can see this on the following slide. The idea is to build broadly diversified portfolios that take into account the global opportunity set and pull in a number of low correlation asset classes to help us improve the overall risk return profile of the portfolio. A couple areas I would point out right here. In the very lower left-hand corner of the equity allocation, you can see our allocation to real assets. This is an inflation hedge that not everybody in the target date industry has. We've had this in place for a number of years, acting as an insurance policy that's actually paying out right now and giving us a way to give a smoother ride during an inflationary period. I'd also point to our diversification in the fixed income markets on the right-hand side. I saw a headline in the Wall Street Journal today that said something along the lines of, we haven't seen a fixed income market as bad as this in more than 140 years, right? And that's true on the headline. But because we've had such a diversified portfolio that includes not just US investment grade bonds, but also international bonds, a dynamic strategy that's focused on and performing in an environment like this, floating rate debt with shorter duration to complement our high yield exposure, and short-term inflation protected securities, all of which have done relatively well and helped us deliver a smoother ride over what's been a pretty rocky period in the fixed income space. And then talk a little bit about active management. T. Rowe Price is known as an active manager. And on the following slide, we think about some of the characteristics that help us generate long-term outperformance. First of all, the people. a team of more than 380 analysts around the world that focuses on working together in a collegial and collaborative atmosphere to bring every idea, vet ideas together in a way that we can find the best ideas for our clients. This is all part of our long-term research-driven approach, where we try to bring together insights across our investment teams, fixed income, talking to equity, emerging markets, talking to developed market managers, and really focusing on the long term that Wall Street tends to miss these days. And then lastly, this outcome-driven culture, this purpose we have to deliver investment excellence for our clients, puts us in a position to deliver. And as we look on the next page about the underlying strategies, you can see the level of diversification and the number of actively managed strategies, flagship strategies across our portfolios to really be able to deliver over the long term. We know that not every one of these strategies is going to be delivering at every calendar quarter or every year end, but over time, when you have a lineup as strong as this one, there are going to be portfolios balancing out underperforming portfolios so that in aggregate, the team provides value added over the long term. And this is what ultimately has generated our results that has accrued directly to our participants. And if you think about this in terms of retirement terms, which is all we're looking at, on the last page that I have, we want to look at it again in terms of how we think about retirement balances. So if we look on the last slide that I'm going to present today, if you think about an investor and how they're managing, if you just start with a baseline of what you could earn, the importance of an extra 25 or an extra 50 basis points is really critical. If you were to earn an extra 25 basis points through your investing time horizon, that would give you about $52,000 in more assets at retirement, which equates to about 2 years of additional spending. If you're able to get a 50 basis points, that accrues to another 5 years of spending. We really do believe that as a combination of the way we've designed our glide paths, the way we've diversified them, our active management, and then our tactical allocation strategy that allows us to navigate for the long term, we can deliver better results such as this for our investors. And let me wrap it up there, turn it over to Chris, see what he has to say to wrap us up, and hopefully have time for some questions.
Great, thank you, Wyatt. Let me just do a quick, if you can give me a thumbs up on an audio check here. Can you hear me? Great. All right. So we did have a couple of questions that had come through. I think we can actually probably go through these relatively quickly. Just as a quick introduction, my name is Chris McAvoy. I'm a DCIO covering New York State and Pennsylvania, as well as West Virginia. So I did see a couple of familiar names on the line here today. It's good to see those names. We're obviously very, very excited about this out in the field. I think this is a great partnership and a great opportunity for us. So I think these questions are probably going to be pretty standard for you all, because you are familiar with the Large Growth Fund 2 and that offering on the platform. But we'll start with what is the difference between the iShare class mutual fund and the CIT? Highest level answer, there is no difference. The difference is effectively the vehicle. It's the mutual fund versus the trust. The trust is an identical, for lack of a better term, it is a clone of the mutual fund. The management, the process, the oversight, as well as the underlying structures, the glide path, everything is replicated in lockstep. So there is no difference between the two. There can be obviously small performance differentials as a result of cash flows, things like that. But effectively those wash out over time, and they tend to be very, very immaterial. The next question, what is the equivalent CIT breakpoint a plan sponsor would need to access this price? So all in, this is at 36 basis points. So that would be a $500 million breakpoint for us, given our CIT pricing construct. The next question is, which record-keeping platform is this going to be available on? This is platform agnostic. So we would expect that this could be added to just about any platform out there. It will take a little bit of time. I think right now the expectation is that you typically would see maybe anywhere from 3 to 5 weeks in order for that implementation to take place. I will say that if you have a preferred record-keeping platform that you would like to have this added to, please contact Wilmington Trust or your flexPATH contacts, as they'll be the ones that will be pushing through the record-keeping platforms in order to get this turned on and available to you all. So, but it should be platform agnostic, and it should be available just about anywhere. And then there's a question on track record. I know this is obviously very, very important. How long of a track record will we be showing on the scorecard? As of right now, it will be 7 years. I believe that's the number. So you'll have a 7-year track record, which is outstanding, obviously, for investment policy statements. I think historically, a lot of those are looking at 3 to 5 years for due diligence processes. So that's definitely a significant win to have an over a 5-year track record on the product. Obviously, you can always reach out to us if you have questions around performance and track record, any sort of differentials, pricing, things like that. We are happy to help you guys in any way. There are obviously resources and the maps, including our territory maps for DCIOs at T. Rowe Price, are available in the RPAG library. So please feel free to go dig those up, contact your T. Rowe Price DCIO counterpart. We're happy to answer any questions, send through any other additional type of information that you're looking for. And then let me just check here. So Wyatt, we did have one question pop up. If you'd like to answer one quick question, there's a question around what makes up, or I should say one additional question, just what makes up the real assets in the series?
It's a great question. Real assets is something we put in the portfolio more than a decade ago. And it was a strategy we custom designed for target date strategies. It's made up of a diversified basket of securities that can provide us inflation protection. So it is primarily commodity producers, real estate, both on a US and a global basis, industrial metals, and precious metals. And each one has different sensitivity to different types of inflation. But as a basket, we believe it gives us a robust portfolio that is expected to perform well during periods of high or rising inflation. And we have seen that come through so far over the last year. And it does represent 5% of our overall equity allocation.
So Wyatt, I think we have another question that falls into your world here. Can you just talk a little bit about expectations around the fully active product versus hybrid performance in our target date products? Obviously, we offer a suite of products, and many of our RPAG members are aware of the full suite.
Yes. So just to level set in terms of the question here for anybody who might, we tend to think of the product we talked about today as our active offer. It does have a very small allocation to an index fund, but for the most part, it is an actively managed strategy. We also offer strategies that have a bit more passive exposure for plan sponsors who tend to be a little more price sensitive. Over the long term, right, the trade-off between those two is going to be the certainty or the uncertainty of what active management can deliver over any period versus the certainty of a lower fee. What we have seen over time is that over longer periods, the actively managed strategy tends to add value on a net of fee basis versus our blended strategies. That being said, there can be situations in which over the short term, the more passive oriented series are outperforming. But what we have found, as I said, given our focus on long-term fundamental research, the approach we put into place, both on our equity and fixed income side, as well as our ability to navigate markets over the shorter term through our tactical allocations, has been value added. And so that's driving that long-term performance expectation for the active portfolios.
Great, thank you. There is one last question in here. And if I'm I'll see if I'm interpreting the question correctly, just regarding active management in the product and whether or not that is done for the CIT, or if there is active management at a participant level to match participant goals. And I'm reading this sort of in a managed account type of construct. So these products are CITs, right? So they are standalone CITs, investment vehicles. So all active management within the product would be done at the CIT level, right? So we are actively investing each one of those dollars into a target date fund. Those target dates are obviously on a pre-described glide path with a pre-described underlying structure, which Wyatt had discussed. And then we have active management capabilities both within the underlying components as well as at a tactical level to move those underlying components where we may see value in the prevailing market environment. So these are not individualized products. This is not like a managed account. These are collective investment trusts that operate in the same fashion that a normal 40 Act mutual fund would. Another question that had just popped up. Is there a minimum asset size of client that can use the CIT? No, there are no minimums for you as RPAG members. So that's absolutely fantastic. It's obviously a very, very compelling price point for you all at 36 basis points for a fully active product that has shown such a tremendous track record at a $500 million break point. Going downscale, that's obviously going to be very, very attractive. We think it's very attractive. We're very, very excited to offer that with you. So there is a question as to whether or not this will be on both of the T. Rowe Price record-keeping platforms. My understanding is that I would have to ask our record-keeping folks because I am a DCIO. Why? Do you have an answer to that?
I believe it will be available on our record-keeping platform.
I believe it'll be available to plans 5 million and up, but we will get back to you with a confirm about that. But yes, it will be available, and our record-keeping associates and team are very excited.
So there's another question, Kim. This is probably going to fall into your wheelhouse here. As the product scales, it says will the product scale, but I'm going to say as the product scales, will we qualify for an even lower fee at some point?
Yes, I tried to keep off of camera, gentlemen, but I'm back here to join you. Yes, so like I mentioned in my previous response, all of our target date strategies are directly tied to one unitary fee schedule. So as the assets grow, they will absolutely, the fee will be reviewed with the national account team and RPAG, and we do fully expect it to grow. And together, once we reach certain breakpoints, the fee will become even more competitive.
Okay.
And I know, Kellen, if there's anything you want to add on the line, I know you're here with us, but feel free to jump in. I just want to make sure we're giving our best info.
There's a question around the slides being available. Yes, the slides will be available. We will make this available as a standard collateral for you.
Loving all the questions. I believe it will be available on the internal resource so that others, if any of your team members or analysts weren't able to join today, they'll be able to listen in.
Oh, I see one more question here as well. How are the 36 basis points split between T. Rowe Price, Wilmington, and flexPATH?
Kim, do you want to take that, or do you want me to take that?
Yeah, Chris, why don't you go ahead and start, and I can add in.
Sure. So the all-in cost being 36 basis points, and then the fee for T. Rowe is a 30 basis point fee for our product, and then the remaining 6 basis points is split for 3 basis points flexPATH, 3 basis points Wilmington Trust.
Perfect.
Okay, I don't see any other questions at this time.
Okay, well, Wyatt, thank you. Appreciate the information. I'll just say again, from the standpoint of our field team at T. Rowe Price, as well as my counterparts on the record keeping side, retirement plan services side, and national accounts, we're very, very excited about this. We think this is a great opportunity. Obviously, we feel very, very strongly about the product that we have in market. We believe in its track record, its structure, its ability to add value for clients over time. And we're super thrilled to be partnering with such a strong network of advisors. So we look forward to talking with you. We look forward to the communication and opportunity to answer any questions that you have, to provide you with the collateral that you need. And as always, really kind of show you what the full capabilities and resources of T. Rowe Price are, and what we have to bear for both you and your end clients. So again, on behalf of my team, national accounts, retirement plan services, our investment staff, Wyatt Lee and his team, and all of T. Rowe Price, thank you so much. We're really looking forward to this.
Thank you so much, Chris. And thank you as well, Wyatt and Kim, for presenting today. We really appreciate you taking the time to, set up this webinar with the RPAG members. We really appreciate that. And to those who are still on the call, if you have any questions that come up after this call, feel free to reach out to us on the support team, support@rpag.com. We'll definitely get you any help that you need or any of your questions answered. So thank you so much, everyone, and have a great day.